Hi, I'm Jimmy. In this video, we're looking at how we can truly protect our investment portfolio. So I'm sure that everybody's heard Warren Buffett's two famous rules. Rule 1, don't lose money. Rule 2, don't forget Rule 1. Now, clearly, Buffett's not talking about a temporary pullback in the stock market. He's talking about losing money permanently. But I figure it makes sense to keep our investment portfolios safer, even if the stock market falls. And if we could do that, well, then our investment portfolio is likely to grow faster, and that should help us get us closer to our goal of financial freedom. Okay, so how do we protect our investment portfolio? Well, one key is to stay diversified, but not all diversification is created the same. So what I did is I calculated the correlation of a bunch of different investments going back the past 5 years. And to diversify our portfolio more effectively, ideally, we want companies or ETFs or sectors or asset classes or whatever it is, we want them to have a lower correlation to our portfolio. The lower the correlation, the more effective the diversification is, and in theory, the safer our portfolio becomes. Okay, now just so we're on the same page, I'm going to walk through a quick illustration of how correlation can affect a portfolio, and I'm going to use real numbers from the actual analysis. So let's imagine we have our own portfolio, and let's pretend that broadly speaking, that portfolio is the SP 500. Maybe we own an ETF or whatever it is. Either way, the SP 500 is going to represent our portfolio. Now, the stock market has been climbing, so we've been pretty happy since our investment portfolio's value continues to grow. Now, at some point, the stock market turns lower. Now, imagine we've considered adding or considered buying some other ETFs to help diversify away from our one holding, which is the SP 500. Now, we're looking at ETFs like IJH, which is the iShares Midcap ETF. And then we're also considering AGG, which is the iShares Bond ETF. Well, over the past 5 years, and by the way, I used weekly numbers to calculate the correlation between all these securities. Well, the bond ETF has a correlation of negative 0.16 when compared to the S&P 500. Meanwhile, the midcap ETF is showing a positive correlation of 0.93. So, what does this tell us? Well, correlation runs on a scale from -1 all the way over to +1. +1 indicates a perfect positive correlation, which means that when one investment moves up 5%, the other investment will move up 5%. When one moves down 10%, the other will move down 10%. So the theory is that the two will move exactly like each other. When we flip to the other side of the spectrum, -1 is a perfect negative correlation. And the exact opposite is true in this situation. So when one stock moves up 5%, the other one would move down 5%. When one moves up 10, if the other one would move down 10. They always move opposite of each other. Finding anything that is perfectly correlated, either negatively or positively, can be very tricky, if not impossible. To find something for the S&P 500 to be perfectly correlated, frankly, you'd have to be looking at another S&P 500 index. So using this scale, well, we may recall that the bond ETF fell right around here, which is negative 0.16. And the midcap ETF came right around here at about 0.93. So if we own the S&P 500 or an ETF that represents the S&P 500, well, we can see that adding the midcap ETF doesn't help diversify us all that much. Now, we can't say that it doesn't help at all. It just doesn't help a lot because 0.93 is quite a high correlation. So it would be like buying two different oil companies. Sure, you help diversify away from that one company risk, but you haven't diversified all that much away from oil itself. Now, the bond ETF, on the other hand, well, this one is actually quite helpful at diversifying our portfolio. We could see that if the S&P 500 were to fall, well, in theory, the bond ETF should, because it's negatively correlated, in fact, be a bit higher. So as the S&P 500 goes down, well, that one should go up, albeit slightly. So that's what we're after. We want to find things with low correlation. The correlation doesn't have to be negative to give us diversification benefits, but the lower the number is compared to our initial investment, the better off we are from a diversification standpoint. Now, take the utility sector just as another example. To represent the utility sector, I use the Vanguard Utilities ETF, ticker symbol VPU. Now, when compared to the S&P 500, the utility sector has a correlation of 0.35, which means that, yes, there is a positive correlation, but the 0.35 is actually quite low, which means that adding utilities to the S&P 500 would be a good diversifier when it comes to protecting our portfolio. So this is exactly what we want. We're after protecting our portfolio. Ideally, we want to protect our portfolio from the what if scenarios. What if the S&P 500 falls? Well, bonds and utilities clearly help that situation. Now, using different sectors is a very good thing. And if we're curious, this is a more complete list of some of the sectors that I pulled down compared to the S&P 500 over the past 5 years. Now, we may notice that the utility sector, well, that has the lowest correlation in this whole group. That's the reason I used them. And the consumer discretionary and information technology have the highest correlation. In fact, the industrials are actually quite high too. But either way, adding each of those three would add some diversification benefits, but not necessarily, as they wouldn't help quite as much as something like utilities would. Okay, but what about other investments? So here's the S&P 500 compared to a few other investment types. We've got a bond ETF that I mentioned before, that's AGG. We have an emerging markets ETF, and then we have another bond ETF, another emerging markets ETF. Then I have an ETF that I found representing the FTSE 100, which gives us access to London stocks. We've got an ETF representing some German stocks, and then we have another one representing some Australian stocks. And we can see that each of these international investments offer a decent amount of diversification benefits when compared to the S&P 500. So that might be something that we consider adding to our portfolio, depending on what our initial portfolio looks like. Now, I recognize that this information, when presented like this, well, it's really only helpful if we want to compare something to the S&P 500. And like most correlation analysis layouts, this is what the more extensive data looks like for each of the ETFs that I analyzed in this particular correlation analysis. So this one is much more dynamic and allows us to compare different things, compare different sectors to each other, and so on. So I put a link in the description below if you want me to send you this entire spreadsheet. Now, I do think it's important to note that I used weekly numbers here going back the past 5 years. And since things change all the time, or correlation analysis would be even different if you looked at 1 year or 3 years or 10 years, I do think it's important for us to continue to pay attention and adjusting our investment portfolio to adjust whatever risk level we're after. I'm just giving sort of a baseline of how this could be done. If you'd be curious to see me do any other types of analysis like that, please let me know in the comments below. I'm always interested. This was a very interesting exercise. Now, if you're curious to learn about other sectors, perhaps, we're actually doing a series on this channel called Dividends from Passive Income, where we're looking for opportunities in each of the 11 GIC sectors. And if you're curious, that could be a good next series for you to watch. There's a link right here, and there's a link in the description below. And thank you so much for sticking with me all the way into the video. I really appreciate it. I hope you found this interesting. Thanks, and I'll see you in the next video.